All right, so we've looked at the income statement and we've looked at the retained earnings statement. Let's move on to the balance sheet. And we have an example of a balance sheet. Looks like we're back to that Paul's Guitar Shop. And we can already see here from the layout of this very, very small balance sheet that we have. This is a really basic balance sheet, that the balance sheet is more involved certainly more involved than the retained earnings statement, and more involved also than the income statement. If we think about just for a moment the accounting equation, we see the accounting equation right here. Assets equal liabilities plus owner's equity. And you may recall that I had told you in the presentation we were discussing the accounting equation that stockholders' equity section of the balance sheet is sometimes also called owner's equity. One thing I would point out is that this apostrophe really needs to be on the outside of this S here. Should be plural possessive, so minor mistake here that whoever put this balance sheet together made, but that's okay. Do notice that total assets are $171,900. We have liabilities of $149,950, and we have total owner's equity of $21,950. If we add these two figures here, we come up with $171,900, and we find out that the accounting equation does in fact hold up. So let's look at our assets. We've got all of some things that we might assume are assets. We've got some cash, accounts receivable. We've got some prepaid rent. We'll get into that later. Inventory is most certainly an asset. It doesn't look like we have much in terms of long-term assets. Now, they've got one big one here listed called leasehold improvements, but you might also find stuff like your buildings, your land that we purchased in the Net Solutions example, machinery, vehicles that are used in the course of business. So those are some examples. Then we have our liabilities up here. We have accounts payable. We have some accrued expenses. And we have this thing called unearned revenue, and we're going to get into that shortly. But unearned revenue is revenue that has not been earned yet, so we have an obligation to perform, and so it's actually a liability. Looks like long-term liabilities, they've just kind of lumped everything together here as one figure. And then we've got owner's equity, some retained earnings, $11,950, and then some common stock, probably a $10,000 investment in this business. Okay, so it's not important that you understand the intricacies of all these accounts right now. That's not important. What is important is that we over the course of the semester, we figure this stuff out, and we understand for now probably that assets do in fact equal liabilities and owner's equity. All right, so we also have the fourth financial statement called the statement of cash flows. And so the reason we have this statement is because we might look at a balance sheet. Let's go back to our balance sheet briefly. And it says here that we have cash of $32,800. But as I'm looking at this, I see, well, gee whiz, our cash is way less than our payables here. If we were to pay these down, we might have a situation where this could go way down. We don't know. So when we think about the statement of cash flows, what we're trying to essentially do is say, okay, how is a company using cash and how are they getting cash? There's a huge difference between getting cash through your normal operations of your business and going to the bank and borrowing a whole bunch of money. So we may have a situation where one year we have, say, $50,000 in cash, and the next year we have $145,000. And on the surface, $145,000 is certainly a lot more than $50,000. But if we got $120,000 of that through bank loans, well, now all of a sudden it doesn't look nearly as impressive, right? So what we do is it says a statement of cash flow consists of the following three sections: operating activities, investing activities, and financing activities. And more specifically, what we're saying here is we're looking at cash inflows and outflows from our normal operating activities, investment activities, okay, and then financing activities. And we don't have to understand what all of these are right now, but I'll just give you a couple of quick examples so you're not completely in the dark. But I think we have some slides just after this that will help us too. We might decide that we're going to go out and invest in some land. If you recall from our Net Solutions example, we had a transaction, our second transaction, where we spent $20,000 on land. Okay, so that would be a cash outflow that was an investment in that land. So that $20,000 outflow would be here in the investing activities. I want to move back up to operating for one moment. We had a transaction where the Net Solutions, they provided some services for $7,500 and they were paid that $7,500. That $7,500 is a cash inflow from operating activities. Okay, and then trying to think if we borrowed any money. I don't believe we did, but let's say that we had borrowed $50,000 from a bank. Well, actually what we did have was we had the owner contributions of $25,000 into the company. That was owner financing is what it was. We didn't go borrow the money from a bank, but we got it from Chris Clark, the owner. So that was an example of a financing activity. Remember, he got common stock for his $25,000. Okay, now this is an example of a statement of cash flows, and I do not want you to be overwhelmed by this. The only thing that I really want you to understand is if we go back to our balance sheet, let's see here. We have cash of $32,800. Now, if you look here, our ending cash balance is $32,800. So what this statement does is it basically just shows us, okay, how did we get to the $32,800? And for now, all I want you to understand is that we got there through a combination of cash inflows and outflows from operating activities, potentially inflows and outflows from investing activities, and from financing activities. Now let's go ahead and look at some examples to maybe help explain these. And we're going to use Amazon because most people are familiar with Amazon. And specifically, we're going to talk about cash flows from operating activities. And it says here, Amazon buys and sells products and hosts third-party sellers via its website. So this is its ordinary and necessary course of business. They are a merchandiser, specifically an online merchandiser. They generally mail items to customers. So when they go out and they buy some inventory and then they sell that inventory, they have a positive cash flow from operations. Regarding investing activities, just an example, it says Amazon invests in equipment, software development, and other infrastructure to support operations. And they may potentially even invest in other companies. Okay. But just as the land that we purchased with Net Solutions was an investing activity, we might have equipment, software, these types of things that we're also going to purchase. I would also say that whenever a company decides to sell an asset that has been used in operations, these are all examples here of outflows of cash. But let's say that we buy a truck and we use it for a while and then we sell that truck. Well, that would be an inflow from investing activities. Okay. And then finally, we have financing activities. It says that the cash flows from financing activities reports cash transactions related to cash investments by stockholders. That's what we saw with Chris Clark when he started the company. Borrowings, we can be for our purpose, let's just talk about, say, a bank loan. And then finally, dividends. If you recall, towards the end of November in our Net Solutions example, Chris Clark paid himself a $2,000 dividend. He is an owner of the company, and so that was a cash outflow of $2,000 related to financing activities because he had originally provided the financing for the company. Okay. All right, our last slide for this introduction is a slide about the interrelationships of the financial statements. And they're all four related to one another. But we talked about there was an order that these financial statements are prepared, and that is highly tied to this interrelationship idea. It says the relationship between the income statement and retained earnings statement. It says net income or loss is reported on the income statement and is also reported on the retained earnings statement as either an addition, net income, or a deduction, net loss, from the beginning retained earnings. Okay, so how much are we adding or subtracting to retained earnings based on how much money we made, hopefully, or lost? Then we have a relationship between the retained earnings statement. If you recall, at the end game of this retained earnings statement was to determine current retained earnings at the end of the period. Well, if we were to go back to the balance sheet and we were to think about the stockholders' equity portion of the balance sheet, what we would see is that retained earnings is one of the two main components of stockholders' equity. So we have to have that ending retained earnings before we can produce our balance sheet. And then we finally have one more. It says balance sheet and statement of cash flows. And I kind of touched on this already. Hopefully you recall. But it says the cash reported on the balance sheet is also reported as the end of period cash on the statement of cash flows. Let's go back and look at that. Remember, this $32,800 was our balance sheet balance right here for cash. And then our statement of cash flows shows all of our inflows and outflows for each of the three types of activities. Okay, so financial statement interrelationships, there's a lot to digest in Chapter 1. Go over it. And as long as you understand the accounting equation and some of the basics, you should be in good shape, and we'll get a little bit more complicated with the upcoming videos as the semester continues. All right, that's it for the first chapter.